Hooty hoo, all my stock market gamblers. Welcome today. It's Monday. Stock market's closed today. I'm getting this out a little bit later, but I thought I'd get a video out because it was fascinating today. I'm telling you, we were down over 500 points on the Dow. The Dow closed up 84 points. What a swing that was. 600-point swing right there. NASDAQ closed up 200 points today. Some people would say that the plunge protection team came in and boosted the markets up. A lot of you don't believe in the plunge protection team. They're actually real. You can Google it. But whatever it was, we had that bounce today. Now, we talked about that on the last episode where sometimes in bear markets you get these big bounces. And it's all it is really is people covering their shorts. They're covering the shorts. It's a short covering rally. Now, we'll see if we get some extension of that tomorrow. I actually expect we probably will get another day, maybe even another 2 days. But we got the Federal Reserve coming out on Wednesday. What are they going to do? Will they tank the markets or keep the rally going? Keep it sending it higher? We'll see. Expected 50 basis point cut, but we'll see what happens. They could send the markets either direction, but I do think we're going to get some follow through on that big bounce we had today. The shorts are starting to cover. They're starting to cover. Now, mark my words though, as this rally goes 2, 3, 4 days, it will be sold off again and we will go lower. But right now we had a big bounce today off of the lows. I mean, we only closed up 84 points. 84 points doesn't sound like an exciting day, but it was quite the day. Very volatile. Volatility very high, spiking up. A lot of volatility out there. Now, what I want to talk today about is bubbles. Now, I believe the stock market's still in a bubble. I believe the housing market's in a bubble. No doubt on both of them. But the question is, what's the pin that's going to pop these bubbles? Well, let's start with the stock market. Now, we're talking about raising interest rates. Interest rates could be the pin that pops the bubble. Inflation, if they can't get it under control, it could pop the stock market bubble. Here's the third one. What about debt? Margin debt. Margin debt's almost $1 trillion. I think it's like $950 billion, right? Well, just in 2020, the margin debt was only at $400 billion. It's over doubled. So we got this debt exploding in a stock market that's at record highs. This could send this market tanking really quick, very quick. Well, okay, so you got three things that could pop the bubble. But what you got is extremes. When you get these big run-ups, I mean, we've had a run-up for 12 years, right? I mean, we have barely had corrections. We've never had bear markets in those 12 years. I mean, that's the longest bull market run in history. But when you get an extreme run-up, you know what follows? Extreme downfall. Look at when you get extremes, it goes both ways and they overshoot. This one's overshooting to the high side. We'll probably overshoot to the low side. So a 50% pullback. Well, we're already down 20% the NASDAQ, right? I mean, another 30% is definitely not out of the question when you see stocks like Netflix, Amazon. I mean, they're just crashing the market with them. But those are the strong ones. I mean, there's some really weak stuff out there. Oh, it's just getting wild. Look at that ARK Innovation Fund. I guess Kathy Woods isn't the genius she thinks she is. Maybe she is. I don't know. But her fund is not doing very well. But okay, so let's go into the real estate bubble now. Now, the real estate bubble, well, a lot of people say, Mike, we're not in a bubble this time. It's different this time. We're not leveraged out with subprime loans. Well, maybe not. Now, if we were in a bubble in 2006, 2007, aren't we in a bigger bubble now? Because prices are higher. Prices are higher than they were back then. And they came down back then. They dropped 34%. Well, I don't think that they overshot. The reason they didn't overshoot, you see, they went up to extremes, but they didn't overshoot down to the bottom, right? The reason was because they injected $3 trillion in 2009, and they started with $3 trillion, and they kept injecting more and more and more. It's like 10 or 15 trillion we've injected to keep this housing market up. I'm telling you, when we're at extreme right now, and when it goes down, it's going to overshoot to the bottom. It's going to get extreme to the bottom. Look at, I've been calling for a 50% crash, and that may be conservative. A lot of people, they just laugh at that. They go, Well, Mike, not in my area. It's impossible. We got buyers. They're just bidding these houses up like crazy. You'd be surprised how quickly this can change, and it's already starting to change. And we do have proof of that. Now, a lot of cities in the Northeast have already come down. I mean, these aren't major cities, but like Pittsburgh. I mean, Pittsburgh's down. There's other ones in Ohio's got cities that are down. Chicago's down. Things are starting to drop, and they're dropping from like 5 to, well, as much as 20% already. I mean, in California, we're already starting to come down. LA's down over 5% already, and it's on the way down, but things are starting to change. Now, there's hot spots. I get that. Maybe Colorado's still hot. Maybe there's some places in Texas that's still hot. I get that, but you got to understand that we're at the extreme up here. It's going to overshoot to the downside. Now, they're going to try to stop it. What are they going to do? Print another 10, 20, 30 trillion? Maybe they're going to try. They're going to do something, right, to stop the downfall. But we will overshoot. Now, I call for 50%, and people say, well, Mike, that can't happen. It's never happened before. We only had 34% in the last great financial crisis, and in the Great Depression, Mike, it was only 26%. What are you talking about? 50%. 50%, yeah, that's what I believe. I believe things are going to be about 50% off soon. It's because... look, we've got everything ready for the collapse in real estate. Now, it could be the same bubbles that pop it. I mean, that same pin that pops the bubble. Look we got interest rates going up. Okay, so the 10-year's over 3% now, but mortgages up about 5.2 to 5.4, head into 6%, maybe to 7%. And that's if you have really good credit score, like 800 credit score you need to get those type of loans, right? Okay, so we are in this extreme overvaluation, but it's also debt, inflation. Inflation could hurt the housing market. People go, well, how can inflation hurt the housing market? Won't it just go up with inflation? Well, no, think about it. Look, what are people going to buy first? Well, they're going to buy food, right? Before you got food, they're going to buy food, they're going to buy gas for their car. Now, these are up 20 to 30%, right? So it's less money to spend on the mortgage, to spend on rent. You see, everything's become so unaffordable. People can't afford to buy homes right now. They cannot. They think they can. Okay, maybe the mortgage broker can stretch you in there with a 40-year loan, but most of the people that are buying the houses right now, unless they're paying all cash and they're very wealthy, they're buying a house that they cannot afford. And when their food prices go up, their gas prices go up, their living expenses go up, well, they have less money, and all of a sudden they can't make that mortgage payment. And so look at this. So they get behind in the mortgage payments, and well, they have a choice. They can sell the house or let the house go to foreclosure. And foreclosure is going to be where the inventory comes from. Only thing we're missing for the crash right now is inventory. Look at that's what's really holding this crash up. I mean, we've already crashed, in my opinion. That's my opinion. When you go from 3% to 5%, that's a shock. That's a shock to the real estate system. This bubble is getting ready to pop. Now, of course, we talked about, how long it takes. It takes time to play out. It takes a year, maybe 2 years before we hit the bottom. And then I don't even know what we'll talk about then. Think of that. What am I going to talk about? Well, I'm going to talk about all the opportunities. There'll be a lot of opportunities, and that's what I'll be talking about. I won't be talking about the crash. I'll be saying, hey, if you can figure a way to get some money together, you can go purchase these properties for, 30, 40 cents on the dollar. And no, it's going to take time for them to come back, though. I don't think they're just going to bounce right back. I think it'll probably be about 5 years. No, they won't bounce back in 5 years. Maybe in 10 years. So it will be a while, but you can start picking them up. You can start to, accumulate houses, and then you can become an investor, right? And commercial property, don't get me started there. Commercial property's in huge trouble. Maybe you want to get into commercial property, but there'll be ways that you can do this, and you can do it with very little money also. And we'll talk more about the opportunities when that comes up. But right now, there's a huge bubble out there, and there's a lot of pins that are circling that bubble, from debt, from inflation, from interest rates going up. There's so many pins that can pop this this bubble, and it's going to pop. It's going to pop. I'm telling you, don't buy into it. If you don't have to buy, don't buy. Just hold off and wait. We'll see what happens. But I really believe that it will pop. I believe the stock market bubble is going to pop also. And I believe when they print another 5, 10, 20, 50 trillion dollars, they ain't going to do anything, right? I mean, it's going to make money worthless. It's just going to get ugly. I mean, it's not a pretty situation right now. But if you can, hold off on buying a house right now. Don't buy into this bubble. Don't buy into the FOMO. Anyways, I hope you enjoyed this. If you did, give me a thumbs up. Get out there, enjoy the rest of your Monday. Bye-bye now.